This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Good morning, ladies and gentlemen, and welcome to the program Dollars and Cents. My name is Joel Garris, and for the next hour, you're going to hear us live on News Radio 93.1. Dollars and Cents is Central Florida's longest-running radio program, started many, many years ago by my now late father-in-law. The tradition continues by me, yours truly, Joel Garris. My goodness, this past week is a perfect example of why you really do need to stick to the fundamentals of investing, because talk about a week with a lot of whipsaw from Monday to Tuesday, Wednesday, Thursday, Friday even. There was a lot of movement in the market. So, of course, we'll talk about that on the program this week, along with the fact that this program marks the beginning of a new era, if you will. As many of you know, many years ago when we transitioned our corporate name over to Nelson Financial Planning from our old Nelson Investment Planning Services, we decided to engage in much more of a social media campaign. And in doing so, we use this radio show as also a podcast. So perhaps you're not listening to us live on air right now. Perhaps you may be listening to us on a day next week, or a day a month from now, or a day a year from now. The podcast channel that we have is either available through our website or through your various favorite podcast channels like iTunes, YouTube, Facebook, Google Play, whatever the case may be. There's a bunch of them out there, that's for sure. Anyway, this episode of Dollars and Cents will be our first video. I actually have a little tripod and a phone, and I'm waving at the screen right now. It's funny, now that we're shifting to this kind of an additional format for our listening audience, or our viewing audience now, I have to get rid of my standard joke, which is I have a face for radio. I do have a face for radio, but now I'm going to be on video. And at the end of the day, the many ways in which you can view us continue to expand in today's world. So besides the markets that were this past week, we will also talk a little bit about an article that we posted on the various social media channels, specifically Facebook. And that article talked a lot about Social Security. And so we'll talk about Social Security on the program today. And then we will talk about some reasons why you may want to consider backing out of a Roth, in essence, converting a Roth back to a traditional, which is something that you don't often hear a lot about, but you often hear about it going the other way, converting your IRA to a Roth. But at the end of the day, there are some reasons why you may want to consider it going the other, more non-traditional way. So we'll talk about that on the program today. Certainly this past week was a bit of a whipsaw week. Monday was a pretty steep sell-off, but then Tuesday and Wednesday were recovery days. Where do you stand at the end of the 5 days for the week that just ended? Well, really not a whole lot from where you stood a week ago. So one of those weeks where the market had a negative reaction to the trade situation in China. Specifically, I think the suggestion that China was manipulating its currency really kind of got the markets on edge and ultimately caused that big decline on Monday. Fortunately, though, we're in the middle of earnings seasons, so a lot of companies were coming out with earnings that showed or continue to show some pretty decent results. So for the week, it was pretty much a wash to a large extent. But certainly it tested folks' emotions and investment approaches. You know, we forget when you look at a lot of the behavioral studies out there, what you'll find is that when we experience a loss, we experience that to a factor that is 3 times greater than the corresponding emotion that we feel when we're experiencing something positive. Isn't that kind of fascinating? Okay, 3 times the emotional impact on a loss versus on an emotion that is positive. And that right there, I think, really underscores how difficult it is with your investments in order to be consistent and to be disciplined over time, because it's so easy to get caught up in that. And this week, once again, was a perfect example of where you could easily get caught up in that, particularly after Monday and the steep reaction. It's one of those things where I always joke with the folks here at the radio station. Mike Yaffe calls me, and we're on the show. His evening drive time show on Monday evening, talking about the market decline, the market sell-off. And I guess that's one of those things where the folks in advertising, the folks in radio, and the media in general certainly understand that concept that you're going to pay a lot more attention to a loss than you are a gain. But it's amazing how big the gulf is in terms of those emotions that we feel. A factor of 3. That's a pretty significant difference. And one of the reasons why you hear so much on the negative side is because that really does capture your attention and really does attract a lot of eyes and ears, depending upon the medium that you're talking about. So certainly from an overall investing perspective, it is certainly one of those weeks where it underscores the need to try and be consistent, the need to not get too caught up in the emotions of it all, because at the end of the day, those emotions are the types of things that we see on a regular basis, or perhaps the single biggest reason why people do not achieve the investment results that they should be over time. It's just easy to get distracted on those types of headlines and those types of reactions. So certainly a bit of a whipsaw in the market, which in our minds further underscores why it's so important to follow those fundamental investment principles of remaining consistent, of remaining invested, of to try not to get too caught up in the day-to-day headlines. Remember, and we talk about this a lot on the program, it's not where you are, it's how much time you have in front of you. Your time horizon is the most important thing when you're thinking about your investments. And I think far too often we think about, I got to a certain age, maybe that's 60, maybe that's 70, maybe that's 75, and now I need to fundamentally alter or change things. And that's not to say that you shouldn't have some type of a shift in your investment allocation at those ages, because certainly when you think of it from those phases as you're working and accumulating, the accumulation phase should obviously be one that is more focused on growth versus the retirement phase, which is certainly more focused on generating income. But you cannot forget the growth part when it comes to the income phase, because you're still going to need some growth in order to continue to be able to generate out the income that you need on that basis, which, given that people are living longer, is at least a 20 or maybe even a 25. I have the pleasure of visiting with many people in their 90s at the office, and so with that perspective, it's a 30-year time horizon. So remember those fundamentals that we always talk about on the program here. In other news, you know that the folks here at the radio station this is owned by iHeartMedia, and iHeartMedia is, I guess, back on track. So that's good. We applaud them for that. They emerged from bankruptcy earlier this summer and appear to be somewhat on track as America's largest owner of radio stations. So we got a little bit of a shout out or an applause to our host company, if you will. We are sitting in the iHeartRadio media studios, and so it's always good to hear that they are sort of back on track, because certainly there was a time period when they were struggling quite a bit. Well, obviously, if you're entering bankruptcy, then you're struggling a whole heck of a lot. But they have emerged and appear to be in a little bit better financial shape. So we're happy about that for them. We know a lot of folks, of course, that work here at the studio, at the radio station. We've had a long-term relationship with them for many, many years. So a little bit of a shout-out to the folks at iHeartMedia for sort of getting through that tough phase and getting back into the swing of things. iHeartMedia owns 848 radio stations, so that's a tremendous amount of capturing on the airwaves. Also, in other news this past week, or really over the course of the past 3 weeks, the reality is that the interest rates really have come down a tremendous amount over the course of the past month. So if you missed the opportunity to refinance over the course of a couple of years ago and you saw those interest rates start to gradually click up, what you will find is that interest rates today have gone back down to the level of where they were 3 years ago. So if you missed it, you've got another opportunity. I don't know how long it's going to stay, that ultimately you'll have a lower interest rate, but certainly it's an opportunity for you if you missed the opportunity to refinance previously when those rates were low. You've got rates now back down to a 3-year low, and certainly a good opportunity to try and refinance if you have not. The ability to get a 30-year fixed rate mortgage, the rate on that fell to 3.6%. That's a pretty low rate for that long of a loan period. So make sure you check that out as well. We're going to take a break. When we get back from the break, we're going to talk a little bit more about Social Security and some of the things that are important to know as it relates to Social Security. We've also got open lines, the numbers to call in and be a part of the program, 407-916-5400, toll free 1-866-916-5400. We'll also, during the break, be checking our email. So if you'd like to send us an email, that email is my first name, Joel, Joel, at NelsonFinancialPlanning.com. We'll look forward to joining you back after these messages.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. This is Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and we're doing something a little different today. Our first video record of the radio show. So those of you who follow us on the various social media platforms will be able to see my face. So no longer a face for radio. We've got the video to prove it. Of course, what that meant is that I actually had to show up a little bit earlier, number one, and I also had to get a little bit more dressed up. Those were the recommendations by my fellow team members in terms of if we're going to do this, we might as well do it. We might as well do it right. It is a little distracting, by the way, because I've got it like on that reverse mode, so I see myself talking and I'm looking at myself and yeah, it's a little distracting. So, but we're going to try something new in recognition of, I guess, where the world is these days, right? And it's certainly back in the day. I remember when we used to do television commercials. I mean, years ago, like 20 odd years ago, it was a much greater production than simply a tripod, a cell phone, and a little one of these little mic things. It's fascinating how much technology has changed, and I would dare say that the resolution on my phone is probably better than the resolution of that camera that was recording those ads 20 odd years ago. So the world changes, and well, shoot, as a business, we attempt to try and change and proceed along with it. As you know, for many years now, we've had this program converted over to a podcast and available on various podcast channels. And from time to time, we like to share with you the reactions of people as they view that. This one comes to a listener on YouTube. Harry talks about the episode we did a few weeks ago about the death of the stretch IRA. We were talking about the legislation that has already passed the House, and it's the Secure Act, and how much the insurance lobby has won access to your 401k as a result of intensive lobbying efforts that they have undergone in Washington, D.C. So we talked about that on a radio program, the death of the stretch IRA, and how the insurance lobby won access to your 401k. Harry's comment is, if this passes, it will be a boom for state lawyers who will have to rewrite or amend all of the trusts. And Harry, you are probably right on that one as well. Certainly, it does change the dynamic. If you think of the stretch IRA as a vehicle that was going to continue on for the course of the beneficiary's lifetime, that's a very powerful estate planning vehicle. If instead that shortens to 10 years, then that's a very different equation in terms of how you plan for that and how you address that from an estate planning perspective. So certainly, as with anything, the estate planning lawyers probably will find that they've got more business as a result. But even more so, the insurance industry will as well. And that's one of the reasons why we have as big a concern as we do about the Secure Act that's making its way through Washington, is that it's very heavily influenced by the insurance lobby, very heavy on the annuity side of the equation, which at the end of the day often is a very expensive, very much a product that locks down your investment and creates a very high cost structure. We saw that just again this past week with someone we had the opportunity to visit with for the first time. They had a portion in cash and were being urged to shift it all into an annuity. And at the end of the day, the individual was 81, and the far better course of action was just to leave things exactly as they were. And unfortunately, that often gets lost, particularly when you talk about insurance products. Primarily, in our view, because they are one of the highest commission products in the financial services industry. They also happen to be subject to a lot less regulation than many others, and than many other types of investment products that you can get out there. So we have some serious concerns with that. Harry, we appreciate your comments on our YouTube channel on that episode of the program. Also, while we're doing follow-up, we excuse me, had a follow-up this past week from a statistic excuse me, that we were sharing in terms of what happens when you miss the best possible days when it comes to your investment results. And that's a statistic that we talk about a lot in the program. It sort of underscores why you want to be consistent with your investments, because the reality is that most of the performance in the market occurs in short periods of time. And so that's just the statistic that we were sharing that really highlights that is the statistic that if you look at the past 10 years, which basically is about 2,500 trading days, because Saturdays, Sundays, holidays don't count. So 2,500 trading days over that 10-year period of time. The reality is all it takes is for you to miss 10 days for the rate of return over the trailing 10 years from June 30th, 2009 to June 30th, 2019 for your return to drop from 14% per year all the way down to 10% per year based upon that snapshot in time. Now, as we've also pointed out, that's a little skewed because that is all post-2008, 2009. So you're getting the entirety of the increase in the market. But the point was that all it takes is to miss just a very small number of days, 10 days out of 2,500, that significantly changed your overall investment results over time, going from 14% down to 10%. Well, a radio show listener asked the question of, on today's show, which was actually last week's show, you mentioned that if you miss the 10 best days in the market, that the return drops from 14 down to 10%. His question is, what if you had missed the 10 worst days in the market over the past 10 years? What would your return have been? How would it compare to missing the 10 best days as well as staying fully invested throughout? Please discuss on next week's program. Well, it's next week, so we're discussing it. And what you'll find is that it's the same differential the other way. Okay, when we did the research, it's the same additional differential if you miss the 10 worst days. It didn't seem to be that much difference. So, for example, if we use that 14% number, where that's been the trailing return in the markets from June 30th, 2019, back 10 years to June 30th, 2009, what you'll find is that if you'd stayed fully invested, annualized return during that particular time period would have been 14%. If you missed the 10 best days, it would have dropped to 10%. If you had missed the 10 worst days, I think I'm getting it confused. So 14%, if I miss the 10 best days, my return drops to 10%. If I miss the 10 worst days, then my return would go up to 18%. So it's in essence that 4% differential, once again underscoring that the vast majority of high performance days, both positive and negative in the markets, occur in a short period of time. And so it's so important to remain consistent because you're not going to be able to pick that out. I mean, in an ideal world, wouldn't it be great if you could miss the 10 worst days in the market over a 10-year period of time? Well, good luck with that. And so I think the differential really helps to underscore that, for the most part, the market does not necessarily do a whole lot on any individual day, week, or month, but there are certainly those time periods where the movement is dramatic. This past week was a good example of that, where you had some dramatic market movement. And given that you're not going to be able to pick those 10 best days or those 10 worst days, it's so important to continue to remain consistent. But we thank you for that question. The reality is it is about a +4 either way. So if you miss the 10 best days, you lose 4% per year, which is a pretty significant loss. If you somehow are able to miss the 10 worst days, then it winds up being 4% to the other side of the equation. So some interesting numbers on that. Great question. We always appreciate those questions offline during the course of the week as well. So shifting gears now a little bit, we'll talk about Social Security. We actually posted this article on our various social media channels like Facebook and the like. It's the 10 common questions about Social Security. Now, obviously, we're not going to go over all 10 of them because it's only an hour radio program, and with the commercials, it's like 42 minutes. But what we will do is we will take a break, and when we come back, we're going to talk about some of the key things to consider when it comes to Social Security. We've also got the topic of converting a Roth back to a traditional, sort of the reverse of what you typically hear. We're going to talk about the situations where you might very well want to consider that here on the program. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. My name is Joel Garris of Nelson Financial Planning. You're listening to Dollars and Cents, where we help you make sense out of all of those different decisions that have anything and everything to do with your dollars. First half of the program, we were talking about the week that was, certainly a volatile one, with the headlines involving China and the trade dispute coming back into the front pages. Certainly a week where you want to remember some of those investing fundamentals, particularly when it comes to ignoring the headlines as much as you can. The reality is that the behavioral studies on this are pretty interesting. We as humans experience a loss emotion 3 times greater than we do an emotion that comes with a positive outcome. So certainly that type of strong fundamental human wiring causes many people to lose track of their investment results and ultimately derail their investment results over time. Speaking of things over time, Social Security is certainly one of those things that you accumulate over the course of time. Found an interesting article out there on the internet that we posted to our Facebook page this past week, and it talks about some of the 10 most common questions about Social Security. We encourage you to kind of review that if you've got some questions on Social Security. We thought we would cover some of the highlights, if you will, on that as well. Also here in the second half of the program, we will open up the lines as well, 407-916-5400, toll-free 1-866-916-5400. Those are the numbers to call in and be a part of the program. Also checking email, the email joel@nelsonfinancialplanning.com. So those are the ways in which you can get in touch with us here during the course of the program here on Dollars and Cents. One of the things that most people don't realize when it comes to Social Security is that it is based upon the average of 35 years of work history. Many people think, it's based upon the past 5, the past 10, whatever. It's based upon your entire lifetime of earnings. And when you stop and think about it, it sort of makes sense because, after all, how much you're getting from Social Security is a function of how much you have paid in. And how much you have paid in is a function of how much you made during the course of your working lifetime. So from that perspective, it's a 35-year average. So if you've got some years that are zeros and you're still working, then the good news is that these years where you are still working are replacing those years that perhaps you weren't working. And so consequently, what Social Security does is it takes a look at those 35 highest years to determine what your Social Security is going to be. So it's not enough to sort of max things out for 3 or 4 years and think that you're going to get a much bigger Social Security benefit. The reality is that it really is based upon an extended period of time that you really want to be aware of when it comes to Social Security. Now, you still need 40 quarters in order to be able to apply for Social Security. That's basically 10 years. That's been the requirement for forever. And ultimately, those are the things that you need to be aware of as it relates to how your Social Security or how many years your Social Security looks at and when determining your benefits. Similarly, retirement ages are changing. And really your full retirement age, where you get 100% of your Social Security benefit, is dependent upon what year you were born. So right now, we're in the middle of sort of that transitioning in terms of the years versus the age for your Social Security. So if you were born before 1938, your full or normal retirement age is going to be 65. Born between 1938 and 1942 is where it starts to shift from 65 to age 66, where each year adds another couple of months between the 1938 and the 1942. Once you get between years 1943 and 1954, then your full retirement age is, in fact, age 66. Past that, 1955 to 1960, then it starts to gradually ascend on up to age 67. And if you were born after 1960, then it's age 67. So be aware of those full retirement ages and how they're kind of right now sort of shifting, if you will, depending upon what age you were born. The traditional 65 certainly doesn't apply. Even 66, you're getting closer to 67 when you look at the ages that people are turning and what their full retirement age for Social Security purposes is. Why does the full retirement age matter? Well, it matters because that's when you no longer have the earnings limitation that would typically apply. If you were still working and wanted to collect Social Security, you're limited to only being able to work and earn $17,000 or it's a little bit more than $17,000 or less. Otherwise, you wind up having to give back your Social Security. The other reason why your full retirement age matters is that if you take it earlier than your full retirement age, then for every month early, there is a reduction of 0.5% each month that you took it early. Now, only the government can come up with 0.5%. I'm not really sure where they come up with that, but that's the calculation. So if we use a very simple example, 0.5%, that's basically 0.5%, right? I mean, pretty close. So if you are taking it 6 months before your full retirement age, then that means that your benefit is going to be reduced by 3% over what you would have gotten at your full retirement age. So when you get your Social Security statement, the reality is that Social Security statement has what you would be getting at your full retirement age. So when you take it early, that's the amount that gets reduced off of that full retirement age number. So it's important to know sort of where you fall in the sliding scale in terms of your full retirement age. And that really does apply for folks born between sort of that 1938 to 1955 age range, where it makes a difference as to where you fall. And actually the 1960. From 1955 to 1960, those are where those numbers are going to shift a little bit in terms of what your full retirement age is. Another question we hear an awful lot is Social Security taxable? And unfortunately, for many Americans it is, and it continues to be that way for more and more Americans because there is a threshold of income that if you're less than that, you don't have to pay and report your Social Security as income on your tax return. However, those thresholds are pretty low and have not changed for at least 30 years. And so more and more Americans find themselves getting tripped up by that. If you're single, the threshold kicks in at $25,000. If you're married, the threshold kicks in at $32,000. So below those thresholds, then your Social Security is not taxable. Above them, it starts to be taxable on a sliding scale, which can rapidly increase to the point where all of your Social Security is, in fact, taxable. So be aware of that piece of the equation that, yes, for most Americans, they'll find that their Social Security is taxable. You have to be below a certain level in order for it to not have any tax implications. And then lastly, one of the questions that we always get is, well, how do I apply? What's the process for application? And that process is actually relatively simple. You can do it in one of two ways. You can get online. You can go to the Social Security Administration's website. It's ssa.gov. Don't get confused with any other websites. But it's SSA, Social Security Administration.gov. It's got to have that GOV designation on at the end because then that tells you it's a government site. So SSA.gov is one place to go. Or you could call, do it the old-fashioned way with a phone and give them a call. 800-772-1213 is that number. So those are the ways in which you apply for Social Security. And in terms of the documentation that you'll need, there's usually a list of stuff that they have out there. Things like birth certificates, marriage certificates, things like that are typically what is asked for. But the process itself of applying is relatively simple and straightforward. So those are the ways in which you would do that. So just some of the many things to be aware of in terms of Social Security. There's a list and a host of others, and we encourage you to check out the article online that we posted on Facebook. We're going to shift to a break. This will be the last break of the program. I need to check email, so I'll do that. And then when we get back, we're going to talk about converting from a Roth to a traditional, sort of the opposite way of what you hear about it. We'll do all of that here on the program Dollars and Cents with Joel Garris, Nelson Financial Planning, News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Welcome back to the program, ladies and gentlemen. My name is Joel Garris. You're listening to Dollars and Cents here on News Radio 93.1 WFLA. Also, making a video. We're entering a new era here on the program, doing a video as well on the radio program. So when you dial into our YouTube channel, you will find a video now instead of just the audio. So as the world changes, well, I guess we try and change with it as well. It is a little distracting because I got this little fob thing I got to keep clicking in and on and off, and that was why there was a little bit of a delay because they didn't have the phone set up correctly. But we're working on it. We're making progress. During the break, I also checked email, and we did get an email from Frank with a good follow-up question on the Social Security stuff. One of the questions that he asked is, if you take Social Security early, is the Social Security income penalty based upon earned income or all income? And that's a very important distinction because the Social Security penalty is based solely upon earned income. So what that means is it's got to be work income, 1099 income, part-time job income. Those types of things are what it is based upon that determines that threshold of that 17,000 and change number. That's an earned income limitation, not an all income. So it's important to draw that distinction because it does not include all types of income. So that gives a little bit more flexibility in terms of what you can do in retirement and still be collecting Social Security, maybe working a little bit, and drawing some money off of retirement accounts or what have you in order to supplement it. Those draws off of retirement accounts would not affect your ability to get your Social Security and be able to keep it, more importantly. So a great question, fair distinction on its earned income, not all income that determines that limitation on your Social Security. It's often times you hear the conversation about, I'm going to convert an IRA over to a Roth. And that's a widespread conversation that you hear a lot about. There's some pros and cons on that. And at the end of the day, we've certainly talked about that in the past. We're usually not much of a fan of that because that means that you are electing to pay income taxes when you would not otherwise have to pay them. That's a very tax bracket dependent type of analysis, but one that we think that you really need to be thinking about that very hard before you just willy-nilly kind of jump into that. One of the things that you don't hear very often is the notion of going the other way. You often hear a lot about going from an IRA over to a Roth, but at the end of the day, you don't hear much about going from a Roth over to a traditional. And in fact, there are some very real reasons why you want to do that. And chief among those is that if you decided to do a Roth earlier in the year and for whatever reason your income changed because now you might need the additional savings on your taxes that would come with doing the more traditional approach. Remember, the distinction between the Roth versus the IRA is that the Roth, you put in after-tax money versus you wind up getting a tax deduction for the IRA. So chief among them is the distinction that you've got to make on that IRA where you're actually saving money on your taxes. There's a bunch of other reasons, but the time is rapidly running out, and so we will table those reasons, the rest of those reasons, for next week's program. So stay tuned to the program next week, and we'll continue this conversation of why it actually makes sense to consider going the other way, going from a Roth over to an IRA. We'll tackle that on the program next week. So thank you for listening. We'll wave bye to the video, and we'll wrap up the program here. Dollars and Cents. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA. Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit nelsonfinancialplanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's nelsonfinancialplanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.